Hi, my name is John Palmer, Senior Vice President and Head of Real Estate Strategies for Westwood. I wanted to take a couple minutes to share my thoughts on the REIT market for the month of February, but as usual, I'll preface my REIT industry comments with some quick observations about the macro. Despite a generally strong Q4 earnings season, February proved to be a relatively disappointing month as far as markets were concerned, with the S&P 500 index finishing down 76 basis points and the Nasdaq finishing down 3.33% for the month. Credit markets fared better as investment grade credit was up 1.64% for the month and high yield came in modestly positive at 11 basis points. We'll go deeper into REIT performance a little later in the video. On the economic side, more questions remain about the state of the U.S. economy and the labor market. The fourth quarter GDP report showed that the U.S. economy grew at a 1.4% annualized rate, significantly missing the 2.8 to 3% consensus estimate. This report marked the slowest pace of growth since early 2025. While many market participants noted that government spending was the main detractor due to the government shutdown, consumption grew more slowly than in previous quarters. Right now, forecasters generally expect the U.S. economy to grow around 2.3 to 2.5% in 2026, but we'll see if those estimates hold as we get further into the year. A key area of emphasis for me is the U.S. labor market. The recent jobs report stated that the U.S. economy unexpectedly shed 92,000 jobs in February, sending the unemployment rate up to 4.4%. Additionally, an influential report by Centrini Research highlighted the potential impacts that AI may have on white-collar jobs, which further underscores investor concerns for the labor market. On the positive side, the January inflation print came in at 2.4% for the 12-month period ending on January 31st, which was down from 2.7% in the prior month. Most investors are watching this closely as we are only 2 months away from a new chair of the Federal Reserve, and it's anyone's guess what will transpire at the next Fed meeting in a couple weeks. But perhaps the most important event affecting markets right now is the geopolitical situation unfolding in Iran and the corresponding impacts that are being felt across energy markets. With oil skyrocketing and the price of gas at the pump moving upwards, this situation has the potential to really slow down the U.S. economy and re-accelerate inflation. It's extremely difficult to underwrite how this situation will resolve itself and how long energy prices will remain elevated, but it's clearly playing out negatively in the short term. With that macro commentary behind us, let's move on specifically to real estate. On the first slide, we show the 10-year Treasury chart since the beginning of the year. The 10-year started 2026 at 4.17% and ended February at 3.94%. So we actually saw rates fall about 23 basis points for the first couple months of the year. Switching to REITs, on the next chart, you'll see the February performance for the MSCI US REIT Index. Generally speaking, REITs had a really strong February, posting a positive 7.5% return, significantly outperforming the S&P 500 and Nasdaq and bringing their year-to-date return to over 10%. Next, I thought it would be helpful to put the February performance in context with the broader market. On the next chart, I have broken out the S&P 500 into its 11 GICS sectors. As you can see, the REITs in the S&P 500 produced a middle-of-the-pack return for the month of February, which is a lot better than their bottom-of-the-pack performance for the full calendar year 2025. On the next chart, we highlight the February REIT market performance by property sector. As I stated earlier, February was a fairly strong month for REITs, with 12 property sectors positive for the month and only 5 sectors negative. The top performers were data centers, specialty REITs, self-storage, and net lease, while office, timber, single-family for rent, and commercial mortgage REITs lagged for the month. Lastly, I thought it would be helpful to show the change in valuations from the beginning of the year. As you can see on this last slide, implied cap rates for the most part have remained fairly steady throughout February. However, the noticeable sectors would be single family for rent and office REITs, which have seen cap rates widen a little bit, while data centers, shopping centers, self-storage, and net lease REITs have seen a bit of cap rate compression. But the overall implied cap rates for the REIT market currently sit in the mid-sixes, which still remains a little wide to long-term historical averages. As always, thank you for your time, and if you have any questions, please feel free to reach out directly to Westwood. I look forward to sharing additional updates with you in the future. Thanks.